I will personally send you $20 through PayPal. If Vanguard was a real person, then I would marry her today. She's cute, she's smart, she's funny, she's always looking out for my best interest, and she's cheap. But of course the good kind of cheap, the highest quality of cheap, if that makes sense. Now that I think about it, this reminds me of a girl that I dated in the past that broke up with me. Ugh, I love that girl. I mean, Vanguard. For all of the beautiful things that I have to say about Vanguard, they actually have a little bit of a problem. And it's honestly a problem across the whole industry, so I don't necessarily want to single out Vanguard here. And the problem is that there are so many freaking funds to invest in, how in the heck are you supposed to know what to choose? It is so annoying. Don't worry, Uncle Jared came to the rescue. I did all of the heavy lifting for you and went through every single stinking one of these funds, so you don't have to. Because I think you're great and I like you that much. If I had to show you with my hands how much I liked you, it would be like this much. That's a lot. In this video, I'm going to give you the best Vanguard index funds out there. I'm specifically going to be talking about the ETF versions as opposed to the Admiral shares, which are sometimes referred to as mutual funds. Hey, I'm Jared with an A, and on this channel, we like to talk about all things personal finance and investing. Just for clarification, the ETF version and the Admiral Share Mutual Fund version hold the exact same investments. The only difference is that an ETF can be traded at any point in time while the stock market is open. The Admiral shares cannot. They are only traded at the end of the day once the stock market is closed for that day. So for example, if it's 10 a.m. and I click the buy button to purchase the ETF of Index A, then my purchase will go through right then and there. On the other hand, if it's 10 a.m. and I click the buy button to purchase the Admiral share version of Index Fund A, then my purchase will not go through until the market closes that day. The reason that I like the ETF version of everything is that the barrier to entry is extremely low, meaning that you don't need any minimum to purchase an ETF, but with the Admiral shares, there's usually a minimum, for example, $3,000. I personally don't like waiting around when it comes to investing the money that I have, so sitting there with cash until I hit that $3,000 is not appealing to me. Let's get this out of the way right now. Some people might say,
but Jared, you have to buy full shares with an ETF, but you don't with the Admiral shares.
Listen here, Samantha, you'd normally be correct, but not if you use the investment platform that I use, which is M1 Finance. They let you buy fractional shares of everything. Link to open up an account with them is in the description. Now I want to do something a little special for you. If you use my specific link in the description to open up an M1 Finance account, then once your account hits $1,000, I will personally send you $20 through PayPal. Keep in mind that that link is an affiliate link and it helps support myself and this channel and my dog at no extra cost to you. I'll also have playlists linked up in the description to all of my M1 Finance videos. As I go through this list, I want to be extremely transparent, so I'll let you know if I'm personally invested in any of these. Quick disclaimer, I'm not an investment advisor. I do think that you should eat a little bit better and exercise more often and get more sleep, but I'm not telling you what to do with your money, and I'm definitely not telling you to invest in any of these funds that I mentioned. Just be smart and do your own research. Before I get into it, please Hulk smash that thumbs up button. The first best Vanguard index fund is the Vanguard S&P 500 index with the ticker symbol of VOO. The goal of this index is to track the performance of the S&P 500. Now, if you're thinking,
well, Jared, what makes the S&P 500 so special?
let me answer that for you. The S&P 500 is made up of the 500 largest companies within the United States from a market capitalization perspective. The market cap of a company can usually give you a good indication of the size of the company. So think of companies like Microsoft, Apple, Amazon, Google. Now, these are massive companies that generate billions and billions of dollars in revenue every single year. These types of companies are also considered large cap companies. Large cap companies are looked at as very stable because of their size. They're less likely to go out of business tomorrow compared to a company like a local grocery store chain down the street from you that maybe only has 2 stores. Just because these are very stable companies does not mean that their share prices won't fall. They of course can, but they are less likely to go from whatever price they are today to $0 in a short period of time. The S&P 500 is only made up of large cap companies, specifically the largest in the United States. Because of that, your money has a very good chance of growing over the long run. It also comes with a super low expense ratio of 0.03, which makes my heart really happy and makes me sleep at night really well. The price is around $250 per share right now, which seems like a lot, but if you are purchasing this ETF through M1 Finance, then you're able to buy partial shares. So you don't need the full $250+ to start investing. And actually, all of the funds that I mentioned in this video are available to be invested through M1 Finance. Full disclosure, I have my future car fund money invested in VOO through M1 Finance. Next up, may I present to you the Vanguard Total Stock Market ETF, VTI. VTI is another good fund to buy and hold, just like VOO is. It's actually kind of the same in that it holds the same 500 stocks that VOO does, except VTI also holds shares of an additional 3,075 companies. So it's currently made up of 3,575 companies. Hashtag math. The goal of the Vanguard Total Stock Market ETF, if you couldn't tell by the name, is to track the performance of the total stock market. To do that, they need to invest in more than just the 500 largest United States companies. VTI is made up of a mixture of large cap, mid cap, and small cap companies to try to achieve this. Because as we know, the total stock market is made up of large, mid-size, and small companies. In my opinion, when you invest in VTI, you're basically investing and banking on the fact that the United States economy will continue to grow. At this point, the US makes up almost 24% of the total world's economy. From 2017 to 2018, it grew by over $1 billion. If you're investing in the Vanguard Total Stock Market Index, then seeing this type of thing makes you happier than, I don't know, finding chewy sour candy that actually tastes sour. Side note and kind of rant, I know sour candy because it's my favorite, and trust me when I say that big candy companies, they lie when they say that their candy is actually sour. It's not, and it makes me really, really sad. VTI is also diversified really well among different industries, which is what you're looking for with this type of index fund. The expense ratio is very low at 0.03, which helps me sleep at night just a little bit better and gives me very, very happy dreams. Disclosure with this one, I personally hold VTI within my Roth IRA that I invest through M1 Finance. If you want to see my portfolio, then I'll leave a link in the description to my Roth IRA video where I take you into my account and show you what I have. Let's change things up and talk dividend indexes. A dividend index is for people who don't feel like going out there and picking individual stocks that are focused on dividend returns. But if you still want to get in on a little piece of the action, then this one's for you. The one I tend to like the best is the Vanguard High Dividend Yield ETF, VYM. This index fund tracks the performance of stocks that are expected to have above average dividend yields. It has a nice low expense ratio, which we all like, coming in at 0.06% or 60 cents per $1,000. Over the past year, they've consistently paid out over 60 cents per share each quarter. The 5-year average return is about 6.98% and the 10-year average is 11.81%. Since the creation of this fund, they're seeing an above average return of 6.28%. Based on history, the dividend distributions have consistently been 60+ cents per share over the past year. One thing to note about dividend paying indexes or dividend paying stocks for that matter is that if they're invested in a taxable account, then the dividends are considered ordinary income within the year that they're paid out. So you'll pay taxes on those dividends. Now, if you hold these investments within a retirement account, then the taxes are deferred and not counted towards income in the current year. I personally don't do any dividend-focused investing right now, so I don't have any of my money in this. If you are someone who wants to use the 3-fund portfolio strategy, then you may want to hold some sort of international fund within your investments. The one that I like best from Vanguard is the Vanguard Total World Stock ETF, VT. Vanguard actually offers 2 different international funds, but this one is going to be more representative of the true international fund. The one I didn't choose only holds stocks and companies outside the United States. Since the US's economy is part of the world and technically the largest, I think that it would be silly to choose a fund that didn't include it. Since it includes the whole wide world, you could see some volatility within the price. Think about it. This fund takes into account so many different economies that it should be expected. US companies make up over 58% of the whole portfolio, which makes sense, but you can also see that it has a decent amount of money invested in Europe and the Pacific. The expense ratio is very low and reasonable, and I like that, so you won't hear me complaining about this. You might have caught my review video on the crowdfunded real estate investing platform Fundrise and thought that, hey, this isn't for me, and that's okay. Vanguard gives you a chance to still get in on real estate investing without doing it through Fundrise or purchasing properties on your own. Enter in the Vanguard Real Estate ETF, VNQ. This REIT holds many different real estate related companies, things like other retail REITs, companies who provide and run thousands of cell phone towers, which I thought was weird, to public storage companies, to many other kinds of REITs that are focused on different sectors within real estate. The larger portion of VNQ is invested in specialized residential and retail REITs. Investing in a REIT is going to help you diversify from stocks and bonds, and this one comes in with a low expense ratio of 0.12%. You could think of VNQ like a REIT made up of a bunch of different REITs. If you want to stick with Vanguard funds that have low expense ratios, then this is the REIT for you. I do have a little bit of money invested in REITs as part of my future car fund, but I didn't end up going with Vanguard. It's nothing against VNQ, but I instead chose to invest in a REIT that M1 Finance curated for me. I mainly wanted to test out the Expert Pi feature that they have, and so far the performance has been absolutely great, and I am loving it. If you're putting together a portfolio, then most people will want to have some sort of bond to be a part of the whole thing to help smooth out the ride when the stock market is very volatile. Enter in the Vanguard Total Bond Market ETF, BND. The Vanguard Total Bond Market ETF, BND, is going to be a good one for you to kind of hold that cash that you don't want to fully expose to the normal swings of the stock market. Keep in mind that the goal in holding a bond is not to necessarily make money. Of course, it's a bonus if you do, and hopefully you do, but it shouldn't be the only reason that you choose one. Vanguard has two bond ETFs that I like, but I chose BND for two main reasons. The first is because the expense ratio is very low at 0.035%. Now, only choosing a fund based on its low cost isn't what you should be doing, but it should still be an important part of the whole decision process. The second reason is because this bond is a little bit less risky. Vanguard rates this one at a 2 out of 5 on the risk scale. Over 70% of the bonds that they hold are either US government bonds, AAA, or AA grade bonds. These are all higher grade bonds, which is a good thing for you. I'm going to say this again because it's important. The point of putting a bond in your portfolio is for the stability. All you need it to do is to keep up with inflation, and this one specifically has been and has the potential to continue doing so. The one I decided not to choose is the Vanguard Long-Term Bond ETF, or BLV. A little over 50% of the bonds it holds is made up of US government, AAA, and AA grade bonds, which means that they have more money invested in riskier bonds compared to BND. I'm not saying the bonds this ETF holds is super risky, but they are riskier than BND. On the risk scale, it's at a 3, so it's not outrageously risky. And another good thing is that the expense ratio is really low at 0.07%. Because it's slightly riskier, the bond index has seen higher returns because of it. And to be honest with you, I wouldn't say that you're an idiot for investing in this bond. It's just a matter of preference. Full disclosure, for the money that I have invested in bonds, I've chosen BND and I'm investing through M1 Finance. Let me know in the comments what you think about this list, if you think that you would add any other ones, or if you think that you would take off any of these. Make sure to Hulk smash that thumbs up button and check out the description to more helpful personal finance and investing playlists and resources that I've made for you. Thanks for checking out this video. I'll see you in the next one, friends. Adios.